Hello and welcome to Core Finance. I'm Matt Brown. I'm joined today in the studio by Shaun Richards from notayesmaneconomics.com. How are you today, Shaun?
Good, thank you.
Right, let's start off. ECB.
There's quite a few things to think about at the minute. Obviously, to some extent, markets are in a bit of a lull. The European Central Bank itself's on holiday. Mario Draghi's probably sipping an espresso right now if he hasn't started on an early glass of Chianti. However, there is quite a bit that's been going on because they're now in a phase whereby the economy is doing reasonably well. If you look at the economic growth figures, a bit over 2% for the euro area over the last year. Even this morning, there's been some decent industrial production figures out of Italy. Now, it's actually quite rare, any decent figure out of Italy. So that beats on, obviously, it's home territory for Mario himself. And then they find on the other side of the coin, though, with inflation, they're below their target and they're relatively hardcore operators on this. They do try and hit the 2% target. And the euro's gone up. Now, if you do the maths and follow the Draghi rule that Mario put out, that will take off somewhere between 1/4% and 0.5% off the inflation rate, all other things being equal. So then we find that they're sort of hitting one target, but the other one's getting further away. If they continue on the inflation line, then they hit themselves a problem. Things are going well now, but they still have negative interest rates. They're still expanding QE at 60 billion euros a month. So what do they do when the next recession strikes?
I mean, that's the key thing, and I think a lot of people now, as you could self, are asking that question, that central banks now need to keep their powder dry and have something in their locker for if we do see a recession. And with QE as much as it is and negative interest rates, central banks now probably almost need to look at preemptive moves, which the market probably won't like, to give themselves that firepower that if we do get into a recession or we have a stock market sell-off, dump, and a credit bubble, again, as we saw 10 years ago, how do you think now that the central banks can manage this?
Well, Lisa, this poses all sorts of problems because if we look at where we are, if we move to something else like bond yields, you hit a recession, bond prices rise, except from here. You know, now you can to and fro over whether you define this as a bubble or not, but the fact is the prices are high, maybe ultra high, and then you find, so what would they then do? So they'd go even higher. Would people take ever more negative yields? There's still places with them, Switzerland, Germany at the short end, fair bits of Europe. And so this poses a lot of questions, as in, you know, people are always saying this time is different. Well, in many respects it would be, in the fact that they haven't even withdrawn the stimulus, let alone gone back to any form of tightening. If you even look at the USA, which is in the lead, it's still only 1 to 1.25%. So there's a big issue here, and especially for those that have gone furthest. If you look at, say, Japan buying equities, if we talk of an equity market fall, it does buy into the falls. Well, how many would it then buy? Swiss National Bank, big potential issue here for the Swiss if one day it pops up and goes, well, you know, it was going really well with those shares we bought and it was fantastic with Apple. Well, now it's halved and well, I resign anyway. Here's the next bloke I'm willing to do the job.
Fantastic. Shaun, thank you very much for joining us today.
Thank you.